Hello and welcome to Bondcast, a podcast series where we discuss our views on the latest themes and events shaping rates markets. I'm Imogen Bachra, European rate strategist, and I'm joined today by our global market specialists, John Briggs, Giles Gale, and Theo Chapsalis. Before getting into our discussion today, I just wanted to quickly remind you to hit the subscribe button so you can listen to our latest episodes as soon as they're available. And as another reminder, if you have any questions you'd like me to pose to our Bondcasters, please email us at bondcast@natwest.com. All right, it's been actually a fairly busy week for what was supposed to be a quiet July. I guess I'll start with Europe because we had the ECB surprisingly present the conclusions of their strategic review last week, which we've been waiting, well, it was delayed because of the pandemic, so we've been waiting around 18 months for that. Of course, they picked the one day that I've had off all year to present that, so that was great timing. So luckily, we've got Giles on today to talk to us about that instead of me. I guess, Giles, first, if you could just give us an overview of what the main conclusions really were and what we learned last week.
Is that we weren't all that impressed by the initial announcement. So it just seemed a little bit sort of high level, generic, a little bit ho-hum, a little bit as expected. So just running through those, we had a new inflation target, which is 2%, which is a nice round number. Symmetry around that was confirmed. Then there was a whole long list of intentions, which I think need to be fleshed out in more detail around the steps that they will take on the climate side, which I suppose we may get into in more detail in future pods. And then there was a discussion about how there was a lot of reiteration of the problems of the lower bound, which I think was a little bit interesting, just because there was a discussion about the need for forceful policy, which in a subsequent interview, Lagarde clarified was specifically when they're dealing with a crisis, and then persistent policy, which seems to be the situation that we're in now, which then sets us up, actually quite interestingly, for the ECB next week.
Leading me nicely into my next question, as if you've done this before, Giles. So what does that mean for the ECB next week?
Well, that wasn't rehearsed. I just assumed that you probably had a question prepared for that one. Yeah, what does it mean for the ECB next week? Well, before last week, we thought that it was just going to be a nothing meeting, to be honest with you. We were really looking forward to September as the point where the decisions might need to be made, or at least a decision in December, perhaps, sort of set up with a meaningful discussion around what they were going to do with asset purchases. And it seems like what they have done is they've brought that forward. They're going to we now think that those big changes are actually likely next week. So there's likely to be a change in forward guidance. We think that that will include some discussion of what to expect in terms of asset purchases beyond March, really pushing back against any temptation that the market may have to just assume that the ECB follows what the Fed does with a lag.
And is that why you think that we had this, they published the conclusion of this review much earlier than expected? They've been working on this for 2 years. The consistent messaging has been that this would come in August, and then they almost seem to rush it out really with not much detail, as you said, ahead of this July meeting. I guess that was almost the biggest surprise of the review was really the timing at which they published it. So is that all about the Fed? Them not wanting the market to interpret that they will follow the Fed, or is it something else?
Listen, I think that you have to believe on one level exactly what they said, that once they're ready, why wait? But I think that they were probably looking at the way that risks were stacked up, as we have been, to be honest with you, in September, and looking to get ahead of that. I mean, one of the things that we've been talking about quite a bit this morning was that they say that they've been learning from their mistakes over the last 10 years. They've made a lot of mistakes. I guess that the ones in 2011, 2012 are the ones that are most talked about. But I think actually, if you look back, 2018 was maybe also a mistake, because we came off a very strong year of growth in 2017 and very high inflation expectations, which then gradually were that momentum was lost, and it was an opportunity to sort of really cement this reflation that could have taken place. It was obviously derailed a little bit by slowing growth and the whole sort of Trump trade problems at that time. But they also stopped QE. They actually tapered down to zero at the beginning of 2019. And I think what they're trying to do is probably make sure that we don't expect that to happen again.
Yeah, I think that makes sense. Well, look, we will catch up again on the ECB next week when we will record this after the meeting. So we'll have the luxury of knowing what they've done then. I guess that leads me nicely onto the US, where, John, we have had 2 weeks where we didn't discuss central banks and inflation, but now you're back. It seems to be the hot topic of discussion again. I guess the best starting point will be yesterday's inflation print. We're recording this on Wednesday, so yesterday on Tuesday, we had another beat. I think that's the third month in a row, which we've had a fairly big beat versus expectations on US inflation. Yet the market didn't actually react all that much at all. It was fairly contained, and in fact, Europe really was unfazed by the number. Why do you think that was? Does the market really believe this is transitory, or was it something else?
So I think it could be one of two things, but in the end, probably a little bit of both. And the first is that, the market is giving the Fed a bit of a pass that it was continuing to be transitory. I mean, a lot of the increases we did see in the inflation side was, reopening type surges, the used car prices going up again, lodging away from home, some things tied to, reopening type things we've seen the last couple of months. The second is that the market is saying that, okay, well, ever since probably mid-May, we talked about this before, when Clarida and other governors came out and started talking about how there's balanced risk to the outlook and trying to clip that right-hand tail of inflation. In other words, saying, yes, we've been talking about unemployment and we've got a long way to go and we're super easy, but if inflation gets very strongly out of control, the capital I inflation, I used to say, we're gonna clip that tail. So, a combination of it's transitory, but also if it isn't transitory, we have credibility and faith in the Fed has credibility, and the market has faith in the Fed that they will tighten in order to do it. So that's why I think you saw in the initial reaction, you did see a bit of a curve flattening, which is, our view. And then we're in that part of the cycle where the market said, okay, here's stronger inflation. We're going to price in a little bit more into the belly of the curve, see yields rise there, but pricing in more rate hikes means the long end probably does not need to sell off on a relative basis. Now we could talk about whether 3+ inflation and 2% bond yields sound investment or not, but that's a different subject. But as far as the market reaction goes, that was basically as expected. I mean, it did turn around when we had a really weak bond auction, kind of on that technical supply issue. So on the end of the day, there wasn't a ton of change on curve. We just had to move higher in yields. But I think that morning reaction to the inflation data is instructive. And like I said, it's a bit of both. I think that, that there is transitory, but if it's not, we have faith that the Fed won't let this run away from us.
So sticking with the Fed, because I guess aside from the inflation print, the other big kind of event that we're watching this week is Powell's semiannual testimony. Now, I should tell listeners that you have the luxury of having seen the prepared remarks. We're literally recording this on Wednesday lunchtime. So I'm putting John on the spot a little bit because we haven't heard the Q&A yet. But from what you've read of the prepared remarks, has that inflation print kind of changed the language from Powell? Is this a dovish kind of testimony, or is this really just in line with what we heard in June?
Yeah, so the headlines that have come out and, the early, thankfully small speech that I could read quickly while Giles was speaking, shows a little bit of a dovishness. And I think that, if it had come out a week ago, you'd probably say, okay, ho-hum, they're still on track. You did have a pretty good inflation number yesterday, so maybe there could have been some expectations that he would flag, inflation a little bit in a different manner. I don't think that was consensus, but if he was going to move one way or the other, you could argue that he would go a little bit more hawkishly. Not our view, but there's a little bit of that out there. And he's pretty much kind of repeated basically the June statement. And I say it's a little bit dovish because he's saying the labor market, we've made some progress. We still have a long way to go. Reaching substantial further progress, which is the phrase that they want to have to initiate tapering. He says it's still a bit of a ways off. They're going to continue to talk about tapering in the coming months. That's all kind of repeating what we've had. On the inflation side, he did flag that long-term price expectations have risen, but I think that that's more not, a near-term flag of warning, but just an observation and a congressional testimony, because he also says that inflation is seen as elevated in the coming months, but then we still see it moderating. We've talked a little bit about how the Fed has started to try to elongate the transitory timeline. When they started this transitory language on inflation, they were really discussing it over the course of several months with base effects from last year. They're trying to stretch that out lately to be supply chain issues, means that inflation could be high for several more months, perhaps into year end. It's a question whether the market lets them get away with that kind of transitory. Is it really transitory? I mean, we have inflation forecasts, again, just to remind listeners, over 3% through the first quarter of next year. So I think that's going to be a real challenge for the markets and challenge for the Fed. But, combining this testimony with the, what you asked about as far as the inflation number, for now, not what markets are focusing on, especially as, the themes have moved away from inflation and more towards Delta variant, peak growth, or we passed peak growth, a little bit of a kind of a summer worry about the synchronized upswing that we still see and we think will probably return as a theme, but maybe not into the fall.
Yeah, that's what I wanted to ask you about, really, when you said that this speech was leaning on the dovish side, is how much of that dovishness do you think is being driven by concerns around the Delta variant? I mean, it wasn't mentioned in the speech, or as far as I can see from the headlines, it wasn't mentioned outright, but it must be something that he's thinking about.
Yeah, I mean, we're recording before the Q&A, so I do think there's going to be some questions about how much of a downside risk he sees, or just a question about Delta variant. But I actually think that most of the questions he's going to get, which, unfortunately, just because of recording time, we're not going to get to see, is about higher inflation, because, usually when you talk about political pressure on a central bank, it's stay easy, stay easy, stay easy. But interestingly, the higher inflation readings are more in the public sphere than they have been in my recent memory, certainly, going back into the 2000s. So, is he going to be pressured more on that side? I think that, he'll flag the Delta variant as a downside risk. Us as a team, we're worried. We're really watching more hospitalizations rather than cases. In the next several weeks, I think we'll play out whether we're just going to have to, finally, can we get to the point where this is, more looking at it like the flu, and if people aren't being hospitalized in highly vaccinated economies, is it overblown fear? I kind of lean that way. But I think for him, he has to flag it as just something they're watchful of, but not something that at this point will change the course of expected policy.
Yeah, no, that makes sense. And I'm just going to take that nicely set up opportunity to remind listeners, if you do have access to our research on agile markets, then check out our COVID monitor, because we've put a lot of kind of good charts and data in there, an analysis recently that looks at the link between case rates and hospitalizations and mortality, using the UK as a case study. And using that as a framework, then it really does look like we can be more optimistic that we're kind of getting more to a stage of where we can live with COVID and hopefully move on from this pandemic. With that, then I'll move over to the UK, because we had inflation data there as well, Theo, and again, another month of higher than expected inflation, not as big a beat as it was in the US, but still sizable. So where are we now? I guess similar question to what I said to John, is are we still on the kind of transitory side in the UK, or is this higher inflation here to stay? And how will the Bank of England think about this with another beat to expectations on the inflation side?
Oh, hi, Imogen. Quite a lot of questions. So let's go and answer them one by one. First of all, with regards to the inflation numbers, it was not a 45 basis point beat, as it was the case in the US, but it was a 35 basis point beat, which I think is still quite considerable. And to be fair, this bears a lot of similarities to the April number that was also very, very strong, caught a lot of investors off guard. Other than the US, we had a fairly soft May RPI print, whereas in the US, also the May print was very, very strong. So you had 3 there in a row. Here we had 2, and one that was softer. What is particularly interesting in the UK is the strength of this print. So it is not that it came just from one category. And clearly, used cars, both in the US and in the UK, they have been stronger, but it's not just that. It is a broader set of items where we see inflation strength. For example, when we look at food prices, there has been a rise. When we look at restaurant prices, so the catering part, there's been a substantial rise. We talk about just catering itself adds 7 basis points to the whole, increase. Then you have obviously other categories such as clothing, which remains rock solid, energy-related items, and investors look very closely what happens to natural gas prices, simply because they will feed into the calculations of option prices towards the end of the year. Now, you've asked on the persistence, and you've asked also what the BOE will do. And the key question is, of course, how persistent it is and what is the composition. And to that in mind, we think that, well, we still believe that it is going to be on the transitory side, or at least perceived to be transitory by the BOE. And this is important, how this will be perceived, not what it is. And we think that there is some hesitance to just accept it as broad-based, simply because there is still the idea that it is a reopening. Some of the data may be a bit noisy, so let's not rush to act. Clearly, the BOE, they do not want to have a repeat of what happened in 2011 with the ECB tightening prematurely and then having to cut. So this is where they're particularly cautious. Now, does it look to be just an outlier? Probably no, and investors are concerned about it. This is why today, for the first time, we had a print that in the UK traded above 5%, an RPI, year-on-year RPI rate, which is a wow. Last time that we had RPI above 5%, well, it was around a decade ago. So it has been a very long time. Now, to your final question on the BOE, how does the BOE react to that? We do have member Saunders, MPC member Saunders, who speaks later this week, specifically on inflation. So we will have to dig into that. So this is one, and it will give us a good indication ahead of the August BOE meeting. I do think that the BOE still will mention that, we'll discuss it as transitory. The point is that they want to see more data. And also the BOE, they do not want to stand out as the outlier that is overly hawkish relative to a Fed that seems very dovish, and, well, an ECB that is also relative to the BOE dovish. So they do not want to stand out as particularly hawkish. What does it mean for the front end? Maybe there is some upside pressure at the front end of the curve, in terms of paying. And clearly, we do expect to see some more paying, now, closer to the meeting, obviously, we will look at valuations and have a stronger view with regards to that. But I would say that for the time being, the market is right to expect some, at least, hawkish considerations from the side of the BOE, even if this is not directly a hawkish shift.
Okay, sorry, I didn't mean to throw so many questions at you there, but thank you for asking them all answering them all so comprehensively, even. So just one more, if I could, moving away, just to round off the podcast, away from inflation and central banks, because the other thing I guess that's been going on in the UK this week is that we had the Longend syndication yesterday. Now, it came on a day where there was quite a lot of global cross-market supply. It was for July at least, it was a fairly heavy supply day in Europe. We had the EU coming to the market with 2 new bonds. We had supply in the US, as John mentioned, and then we also had the syndication in the UK. So how easily was that digested, and what kind of indication does that give you about next week's Longend supply event?
Yeah, flows and the ability of the market to absorb any issuance, I think, will be key. It is interesting how easily the supply got absorbed. We talk about 7 billion. The market rallied on the day of the syndication. Gilts outperformed on cross-market basis. So there's been genuine gilt strength. This coincided, however, with coupon payment. So it was a week of heavy coupon flows. Clearly, the DMO, they're aware of that. This is why they time these events appropriately. We do have a big index extension next week, and this is going to be around 10 million a basis point. At the same time, we have the longest bond being issued, and that bond, the 71s, that bond, it is quite a significant duration event. I do think that at least until next week, there will be some support for the gilt market for duration. It's different what happens after that, and maybe after that we have an opportunity to become more aggressive on the bearish side. But for the time being, there is support for UK duration because of all those index expansions. And I think that investors should definitely be cautious, especially if you want to go much short now, despite those low levels, because technicalities can support the market. And to be fair, supply has consistently been easily absorbed in the UK. The other point that I would raise is that when there is a genuine increase in rates, particularly in the UK, there is a propensity for real money to step in and buy that cheapness. So that creates a reduction in volatility at the back end of the curve. So there is also a lid with regards to how high back end yields can go.
Okay, well, perhaps we'll revisit that kind of discussion around bearishness next week then, after these events are out the way. But I think that's everything for this week. Thanks everyone for joining me again. And just a reminder to listeners, if you liked today's episode, then please hit the like button to show your appreciation and click subscribe so you can listen to our latest episodes as soon as they're available. And if you would like to pose a question to any of us, please reach out at bondcast@natwest.com. Thanks again. Catch up next week.